We're living in uncertain times, and while nobody can predict the future with 100% accuracy, here's what separates the smart investors from everyone else. They don't just make one prediction and hope they're right. Instead, they run through multiple hypothetical scenarios to stress test their portfolios. That way, if one of these scenarios plays out, they know how to position themselves to protect their portfolio or even profit. Today, I'm going to run through 10 possible scenarios for the Australian market in 2026. Now, will they all happen? Probably not, but thinking them through now can help you identify gaps in your portfolio. Because even if one of these plays out and you're not prepared, it could seriously damage your returns. I'll also show you exactly how to navigate each of these scenarios using ASX listed ETFs, whether it's to protect yourself or to profit. We're covering everything from the RBA potentially hiking rates instead of cutting them, to a massive commodities boom, to some surprising international moves that could leave the Aussie investors in the dust. Let's get started. Scenario 1. Is Australia about to experience another commodities boom? This isn't just wishful thinking. The evidence suggests that it has already started. City analysts see the bull market in gold and silver broadening into copper and aluminium, meaning base metals could lead as infrastructure and energy demand ramp up. Strong global demand, especially from Asia or war-related supply disruptions, could send resources soaring. Industrial metals like copper and aluminium could jump on manufacturing and green energy transition, while gold extends its bull run. For Australia's resource-heavy market, that could mean windfall profits for miners, better terms of trade, bigger government budgets, and sector-specific ASX outperformance, if you know where to look. We already have a strong exposure to the commodities theme in our best ideas model portfolio. We have exposure in BetaShares Australian Resources sector, which is ticker QRE, and VanEck Australian Resources Fund, ticker MVR. We also have exposure to BetaShares Energy Transition Metals, which is ticker XMET, and Global Copper Miners, ticker WIRE. Ask yourself, is your portfolio positioned for commodities boom in 2026? Scenario 2. What if ETF money creates a crowding problem? Australia's ETF industry surged past $300 billion Australian in September 2025 and could reach $500 billion by 2028. Investors love the low fees, diversification, and solid returns. But there's a catch. The top 3 ETFs, VAS, VGS, IVV, hold nearly $50 billion, which is mostly in cap-weighted indices. This means that for every new dollar that flows, it goes into banks and miners, increasing concentration and reducing true diversification. That concentration means crowding. Too much money is chasing the same handful of stocks. It's a growing risk because it leaves investors more exposed to a small group of blue chips than they realize, even if those names start to stumble. So hypothetically, here's what I'd do. Diversify your ETF mix. Use VanEck's Australian Equal Weight ETF, MVW, or BetaShares X20 ETF, EX20, to avoid mega cap overload. Spread across themes and sectors. Don't get stuck in Australian specific ETFs. Remember, there is a world of opportunity outside the Aussie market. Focus on investments in uptrends. Don't get stuck buying and holding ETFs with large allocations to parts of the market that are clearly in downtrends. Always take the time to understand the investment allocation in your ETF and never buy multiple ETFs with the same underlying exposures. 2026 could be another year where home bias costs you serious portfolio performance. Scenario 3. What if Aussie blue chips underperform? Here's the reality most people miss. Many Aussie blue chips are mature, low-growth businesses, and several are coming off cyclical peaks. Yarra Capital's analysis for the ASX 20 shows that over the 3 years to September 25, the index is up about 51%, but earnings are actually down roughly 19%. Remember, over the long term, valuations follow earnings growth. 14 of Australia's top 20 companies are expected to earn less in 2025 than their previous peak, and in 8 cases, earnings are over 20% below the peak. For the big banks, sector profits are forecast around $34.3 billion in next year, compared with $34.9 10 years ago. Effectively a lost decade for earnings, yet prices have held up thanks to passive ETF flows and yield chasing, even as earnings stall. That prices up, earnings flat or down gap could easily close in 2026. At the same time, leadership is already shifting. The ASX Small Ordinaries is up 21% year to date versus 8% for the ASX 200 after years of small cap underperformance. Ron Shamgar of Temim argues small caps have lagged large caps by a very wide margin in recent years, implying roughly 20% upside just to get back to trend. So hypothetically, if blue chips struggle, the move is simple. Stop being all in on Australia. It's less than 2% of the world market. Ensure your core portfolio is not overweight Australia. And if you still want to be heavily invested in Australia, tilt away from the usual giants with Vanguard MSCI Australian Small Companies, VSO, or iShares S&P ASX Small Ordinaries, ISO, for small caps, and BetaShares X20 to avoid the top 20 and own the next 180 stocks. If there is no earnings growth in Australia in 2026, why would you continue to maintain an overweight exposure? Scenario 4. What if thematic ETFs crush the index yet again? This kind of market shows up when gains are very uneven. A handful of sectors rip, but not the ones that dominate the index. We've already seen that in 2025. Global X Battery Tech and Lithium, ACDC, Global X Uranium, Atom, and Global X Hydrogen, HGen, have all delivered strong double-digit 12-month returns, while the index has only managed single-digit gains as of late 2025. Hudson Financial Planning's 2026 Global Investment Outlook argues that structural themes are likely to beat broad indexes, highlighting AI, automation, infrastructure, resources, defense, and nuclear. In that kind of market, the headline index can look so-so, while the right themes quietly run, a classic stock pickers environment where sector and thematic ETFs can shine. But remember, past performance is not a guarantee. The themes that worked in 2025 most likely won't be the biggest winners of 2026. Now, I track all these themes and identify which ETFs are breaking out from base to trend in my weekly newsletter. Each week, I analyze the Australian market and show you exactly how to position your portfolio for what's coming next. Since launching in June 2025, our model portfolio has returned 13.08% compared to just 4.09% for the ASX 200. The link is in the description. Scenario 5. What if India's stock market starts firing again? India's market has delivered 9 straight winning years, fueled by the fastest growing major economy, which is around 6 to 7% GDP growth, strong earnings, and a surge to well over 150 million retail investors piling in. By 2027, India's economy is expected to overtake Japan and Germany to become the world's 3rd largest, and its stock market could also potentially crack the global top 3. Global firms like Morgan Stanley call this India's decade and see a realistic path to that outcome if growth and reforms stay on track. The risk for Aussie investors is not knowing how to play this theme and when. The ASX has Indian exposed ETFs such as BetaShares India Quality, IIND, or Global X India Nifty 50, NDIA. However, we are yet to buy due to currency weakness. When these ideas set up, our subscribers will be ready to profit from what could be one of this century's greatest economic transformations. Scenario 6. What if big money flows back to China and Hong Kong? Sentiment toward China has been deeply bearish in recent years due to the property debt crisis and regulatory crackdowns, leaving many global investors structurally underweight. Yet 2025 has already seen a sharp rebound. Hong Kong's Hang Seng is up around 30%, and the mainland CSI 300 about 16%, helped by policy easing, stabilising prices, and improved earnings. HSBC Asset Management notes that valuations in Hong Kong and China still look attractive versus other major markets, while global investors remain significantly underweight. The surprise scenario is that this recovery not only continues, but accelerates, with UBS now expecting A-share earnings growth to rise from about 6% this year to 8% next year. If investors decide they've overpenalised China, that mix of cheap valuations and underweight positioning could drive another year of outsized gains, potentially 20% plus, as the narrative flips from China is uninvestable to China is back. To express this view in a diversified portfolio, investors could use broad China ETFs such as iShares China Large Cap, IZZ, or Van Eck China New Economy, CNEW, for tech, healthcare, and consumer sectors, or even BetaShares Asia Technology Tigers ETF, Asia, for major Hong Kong listed names. Here, even a small allocation in your satellite portfolio could move the performance needle in 2026. Scenario 7. What if energy roars back? Oil spiked in 2022, but has since cooled, with the IEA now expecting a surplus in 2025-26, and major forecasters like the World Bank and EIA seeing Brent average around $55 to $70 US a barrel and often in the low 60s. But this scenario flips the script. Current oil prices are so low that new exploration is not profitable, and OPEC really needs higher prices soon to start balancing their budgets. So it is a case of when, not if, oil prices start to rise again. If emerging market growth and travel demand keeps strong while supply disappoints, oil could easily retest US $100 a barrel. In that world, energy stocks could again significantly beat the broad market as they did in 2022, with 40 to 50% sector gains while global equities fell. We might also see other energy commodities like coal or natural gas rebound, given Australia's sizable exports there. So hypothetically, if energy roars back, you could tilt towards BetaShares Global Energy Companies ETF, Fuel, for currency hedged exposure to major oil and gas stocks, and BetaShares Crude Oil Index ETF, OOO, for more direct crude futures exposure. Is your portfolio positioned for a potential energy resurgence in 2026? Scenario 8, gold continues to glitter, but the real moves happen in other commodities. Big banks remain very bullish on gold. Citigroup recently had a short-term gold target around $3,800, while UBS sees gold reaching roughly $4,500 by mid-2026, well above today's record prices above $4,000 an ounce. At the same time, central banks have been buying more than 1,000 tonnes a year since 2022, and ongoing inflation, geopolitical risk, and worries about real yields all support gold as a defensive hedge. The twist is that other commodities could rise even more on a percentage basis. Copper has already pushed above $11,000 a tonne, and Citi sees scope for $13,000 a tonne by 2026 if electrification and AI demand keep tightening supply. Uranium forecasts are similarly punchy, with some analysts expecting prices well over US $100 a pound and even peak scenarios around $150 a pound. In that world, gold grabs the headlines with new highs, but copper, uranium, and broader resources quietly deliver bigger gains. So hypothetically, how might you position for that? Use Global X Physical Gold, GOLD, as your core hedge. Then add broad resources exposure via BetaShares Australian Resources Sector ETF, QRE, or Van Eck Resources Fund, MVR, plus more targeted exposure through Global X Copper Miners, WIRE, Global X Uranium, Atom, or even BCOM, the Bloomberg Commodity Complex ETF, to capture potential outperformance across the wider commodity complex. Ask yourself, do you have enough exposure to commodities for 2026? And scenario 9, what if the government collects record tax revenues but keeps spending and crowds out the private sector? Let's suppose a renewed resource boom sends mining company taxes, LNG royalties, and income taxes surging as high commodity prices and strong nominal GDP push revenue to very high, near record levels. But instead of saving the windfall, the government spends aggressively on new programs, subsidies, public hiring, and big infrastructure projects. In a near full employment economy, this can crowd out private activity. The public sector soaks up scarce resources, labour and capital, forcing private firms to pay more for staff and materials or shelf projects altogether. If spending drives a deficit despite strong revenue, extra bond issuance contribute to higher bond yields than otherwise, keeping borrowing costs and credit conditions tighter for households and businesses. Non-mining sectors slow while inflation stays sticky because public demand remains strong. Resources companies may be fine, but domestic-orientated businesses feel the squeeze. If that kind of crowding out dynamic appeared, you could think about reducing Australian-specific risk by tilting more offshore, with global ex-Australia ETFs such as iShares MSCI World ex-Australia, IWLD, or Vanguard MSCI International Shares, VGS. Being selective with your investment allocations. Don't allocate to sectors that are challenged by the above scenario. Allocate to sectors that will benefit. One such area will likely be resources, which are operating within their own cycle now. You can access these themes via BetaShares Australian Resources Sector ETF, QRE, or Van Eck Resources Fund, MVR. I fear Australia's policy settings are ill-equipped to navigate what could occur in 2026, so investors need to be thoroughly prepared for this scenario. And scenario 10, what if the RBA hikes rates instead of cutting? Everyone's been hanging out for rate cuts, but the RBA governor is now signalling there may be no more in this cycle, and markets have sharply wound back expectations. If inflation stays sticky, the next move in 2026 will be a rate hike. Demand is still outpacing supply, keeping inflation above the RBA's 2 to 3% target. Higher for longer rates mean elevated borrowing costs and pressure on rate-sensitive sectors like housing and consumer discretionary, as more household income goes to interest instead of spending. We've already seen this play out. After a strong November jobs report released in December 2024, markets slashed the odds of a February RBA rate cut, and property and consumer discretionary names sold off from recent highs in a single session. So I'd be positioning for a period of higher inflation for longer, and therefore higher interest rates. This means minimize exposure to interest rate sensitive sectors, avoid banks, retail, property, and industrial sectors. These are priced for perfection and will falter if rates don't come down. Position in themes that will do well despite rates and inflation. There are certain sectors and themes that will do well regardless of inflation and rate expectations, and they are already showing their leadership. Sectors such as commodities, resources, and themes like AI, energy, and robotics. Avoid term deposits. Don't make the mistake of locking up large amounts of cash at a rate that may look okay now, only to cost you dearly as inflation ramps up and eats away at the value of your cash. For cash buffers, you can consider BetaShares Australian Bank Senior Floating Rate Bond ETF, QPON. The distributions or coupons adjust with the interest rates, so if the RBA hikes, your income can step up instead of getting squeezed. And BetaShares Australian High Interest Cash ETF AAA, an ETF that invests in a range of high interest bank accounts with interest rates that will increase in line with any moves from the RBA. Bottom line, while tame inflation and ever lower interest rates have been the investment backdrop for the last 30 plus years, it is becoming more and more evident that the game has changed. So don't get stuck thinking what happened in the past will continue to happen in the future. So what do you guys think? Drop a comment and tell me which scenario you think is most likely to play out. Now, if you want ongoing, up-to-date analysis of the Aussie market and how to position your portfolio with ASX-listed ETFs to protect yourself from scenarios just like these, check out my weekly newsletter. There's a 4-week free trial and 20% off annual plans. Click the link below and I'll see you in the next one. And as always, remember to follow the trend.